Welcome to the Broken Pie Chart Podcast, episode 387. I'm your host, Eric Moore. With me once again is Shane Skinner and Mike Snyder, or Mike Snyder and Shane Skinner, whichever you prefer. All right, all the talk this week after the Google earnings were CapEx. It was announced Google was ramping up their CapEx. We heard about free cash flow went negative for the first time ever in Google's history. Uri Timmer put out a chart on the Mag 7. And basically what this chart shows is the trailing earnings per share, the trailing CapEx, that's what they're spending on plant, property, equipment, and any other things. And then the payout. And the payouts is dividends plus buybacks. So let me stop on that for a second. There's something called the payout ratio. And the payout ratio is like how much of your net income are companies either returning to shareholders as a dividend or as a buyback. So let's say if a company makes $100 and they pay out 50% of it as a dividend, and they paid out, or they used another 40%, so now they're up to 90% total, buying back their own stock. Because buying shares of your own stock, share buybacks, is returning stuff to shareholders because it's reducing the float and your EPS goes up. So what he was saying is the payout ratios on the Mag 7 have been lower. On this chart, and they call it the jaws, and there's a picture of a shark. And it's kind of the difference between the trailing CapEx and the trailing, what else? Yeah, the payout ratio. And basically no surprise, like they're spending a lot of CapEx. The market didn't like Google. The market, when Google came out and Google basically said, and I've got this in there, guys, Alphabet, the free cash flow, FCFS. Yep. So free cash flow to shareholders. Negative. And I think this goes back to March of 15, first time it's been negative. Google gapped down and market didn't like that. So, this isn't new for us. We've been talking about this. Shane, I would make the argument, is this a big deal or not a big deal? Because you know what I would say? Yeah, they're spending it, but it's increasing the free cash flow for other companies.
Yeah, I think that in terms of, if you're looking at it from the index perspective, it makes sense why, if Google's spending a ton of money and giving it to other names within the index, then that money's not really technically leaving the index, right? It's just exchanging hands. And I think this just comes back to whether or not this CapEx spend-a-thon that we've sort of seen here actually creates returns. And there's a ton of ways that I think those returns could be made. I don't think it necessarily is fully dependent on what happens with data centers or what happens with, chips. I don't think it's just one thing. AI is still, it sounds like, in the early innings based on what we're seeing and based on how we are using it. And it just seems like, it's a matter of, in the next couple of months, I think we're going to figure out whether some of these hyperscalers overshot and, might face a correction because of that, a little bit of a repricing, or, maybe there's going to start to be returns popping up in the coming earnings calls over the next few quarters that start to really justify this CapEx spend.
I mean, if we were going to measure the kind of the standard CapEx ROI, you'd say, what's the benefit divided by the total capital cost, and then you multiply it by 100. That's how you get your return on investment on the CapEx. I mean, this is the problem. This is, I think, what the conundrum investors and analysts are looking at. And it's this idea, I mean, Mike, are they just doing it because if they don't do it, it will hurt them more? It's not about the return necessarily. It's about keeping up. But I guess that's the thing. Is there a legitimate case to say we're going to spend all this money and the ROI is going to come on the back end?
I think, a company like Apple might say, no, there isn't a case for it. But I think there is a group of companies that believe if they don't do it, someone else will, and they're going to fall behind. And maybe in the long run, they don't end up actually earning, the return they're hoping for on this CapEx, but without spending it, it may impact them even more, right? If they're not able to keep up. So I think right now the market's saying, the more predictable dividends and buybacks, the return on that is estimated to be better than the return on the CapEx. But I'd like that position that if they don't do it, someone else will, and it may end up hurting them more not spending this money.
I mean, there's an argument too to say, okay, yeah, of course, you want to spend $1 and you want to get such and such back on every dollar. And ideally, you spend that $1 and you get more than $1 back in benefit. For a long time, though, the knock on these companies was they have nothing to do with their cash. They have nothing but cash coming in. Why don't they do an acquisition? Why don't they expand? Why don't they do something instead of just doing buybacks? I mean, that's what they're doing right now. Sure, they went negative free cash flow for the first time ever, but I mean, they're spending the money, they're investing it. The question is, do they get back that return? It's early though. I mean, it's really early in this cycle, and I don't think we're going to know the types of return or what the return on the investment is for a long time. I mean, if a company, Shane, here's the thing. Imagine Google just said, we're not even going to get involved in this. There's no Gemini, there's no nothing. I mean, people are using Gemini a ton, whether they understand it or not. When you go to Google, the first set of results come up as sort of the AI output. And then you can go into AI mode. And you got to believe they're going to be monetizing this. Like Google has kind of figured this out. So,
yeah, no, I agree. I don't know if you've seen, but you get ads, and I think ChatGPT does this now too.
They do.
Yeah, you'll get ads, and I think that something the market. I'm not trying to be doom and gloom with all of this because
no, do it. Let's make a bear case and a bull case. Let's just take both sides.
It takes you got to spend money to make money. I love that phrase, right? But seriously, like when thinking about building out this AI thing, you've got to spend money, and there's a really good chance that when building out a new technology or a new sort of disruptive layer of infrastructure across the economy, basically you have to take risks, and there is the potential that some of these investments aren't going to pay off. And that's the beauty of free markets and sourcing capital and how this plays out. Some people win, some people lose, but at the end of the day, the commitment to AI isn't going away, it seems like. And what I think the bull case here, for once I'm going to give the bull case on this side, is that you have some incredible breakthroughs over the next 6, 12, 18 months in compute, in demand for memory, in all these other areas or AI that's servicing businesses. You start to see things not cost as much. You start to see adoption across the entire market. And it could really go a multitude of ways, right? But I think that's the bull case, is that all of a sudden news comes out about some incredible breakthroughs, and then things become more affordable. It's not as costly to invest in it, nor is it as costly to implement it. And we start to see adoption across the board.
Well, I mean, the value case on this for the value investors, the value factor is that all of this technology spend is going to accrete benefits to the value companies. So I always go back to BASF as a company in Germany. I think they still trade in Germany. And it's the idea, imagine that company, which I think is a chemical company, right? BASF. I got to look that up. See, they do a bunch of stuff. They used to make cassette tapes, believe it or not. But, a company like that, it's like, oh, now we have Excel. Oh, that's interesting because now we don't need, XYZ. Now we have email and we have all this stuff. Like there's always these technology benefits that sort of come down. Yeah, BASF is a chemical company. They're in Germany. Yeah, there you go. Dr. Marcus Kamith is the chairman of the board, in case you're wondering that. So that's the thing. It may not be these companies that get all the benefit, but it is, I'm going to guess, other companies. I think people make the misguided connection or comparison to Y2K. So for anyone who doesn't know, wasn't around in Y2K, there was this little glitch where they never really programmed in when the date changed from 1999 to 2000 to use 4 digits. I'm oversimplifying this. So it was like, 98 to 99, or 80 to 81. Wait a second, 99 to 00. So there was a bunch of Y2K spending, but that was a one-time thing that happened. And I think this could last much, much longer. It's just a question of who gets the benefit. And I always say, Netscape was probably the first browser. Nobody Netscapes anything. They Google stuff. Google was whatever umpteenth browser that came out. So, Mike, when I look at this though, and I still think I want to see what Anthropic's S1 looks like. They filed, was it June 1st? Yeah, I think they filed for, and it's a private filing, but then eventually comes public. Like, that's the one I want to see. Like, I really want to get a look at what the revenues are. It's rumored that it's $100 million.
Yeah, that'll be an interesting one to see. A lot of they're solely focused on AI. So, when you look at a company like Google, they have their hands in a lot of different areas. So it's not really just an AI play. So Anthropic will give us a good idea of where things stand. But, I sort of look at AI and kind of compare some of it to the social media boom when, 15 years ago, social media became very popular, and, it had all these users, but everyone was questioning, can they actually monetize it? I think that's sort of the same thought right now, is how do these companies monetize AI? And then how do companies that aren't creating AI products use AI to benefit them, right? And we've seen companies like Procter & Gamble benefit from social media by advertising on social media. Everyone is using social media now, and Facebook, Meta eventually figured out how to monetize that. And so I think we're sort of going through a similar phase here with AI.
I wonder if Mark Zuckerberg ever just goes back and changes the name back to Facebook, because the Metasphere, was that what it is? The Metaverse?
Metaverse.
Yeah, like that. I don't think that was really a good spend of dollars. Let me give you guys, Charlie Bilello put something out. And by the way, if I didn't credit that Mag 7 chart, that was from Uri and Timmer at Fidelity. So he puts out some good stuff. Charlie Bilello put out, this was today, percent below all-time high. And then he lists some asset classes. He lists some different securities. So he puts on here, Apple's a percent off their all-time high. The S&P is 3% off the all-time high. Although the last couple of weeks, it's like when the market's down, it's almost like it's down 20%. That's how people feel sometimes. NVIDIA's off 13% all-time high. Amazon 17%. Google 22%. Meta 25%. Gold 28%. Microsoft 31%. Tesla 37%. Palantir, 42% below its all-time high. This is what we always say, right? Individual stocks, they go up and down all the time. It's not unheard of for these stocks to go up or down 50%. Netflix, almost down 50%. SpaceX, down 49%. Bitcoin is down 50% from its all-time high. Silver, minus 52%. MicroStrategy, minus 83%, and then they have some meme coins in there. Like, this market is not all acting the same way. And you also have stuff that's making all-time highs. I think we've seen Caterpillar has been there. Lilly is not that far off. We've seen, United Healthcare of late. It's not at an all-time high. Their all-time high was like 615 or so, but it's in coming in on mid-ish 400s. So, like, this type of dispersion is really, really interesting to me. Google was up 100% at one point year over year. Now it's down 22% off its all-time high. I want to focus in on Tesla though and SpaceX. And like, I don't know if Tesla's report was that bad, but what do we always say? Single stock risk. Earnings, stocks go down sometimes. So Shane, I'm going to ask you, like SpaceX down 49% from its, and that's not from first trade. So from first trade, I mean, what is it down from its all-time high now? It's got to be, I'll calculate that for you.
Yeah, please do. I think the high, it's at least down 50%, I think.
Yeah, I'll get that for you. But I mean, is Tesla down because of the earnings report, or is Tesla down because, if we merge with SpaceX and SpaceX is not 200 anymore, we have to account for that?
I could see that. I think that there were mentions in the recent report or call about, Tesla vehicles being sort of synced up with some of the stuff SpaceX has in terms of their satellites and tracking and things. And that's really, I'm going back to what we talked about last week. It wouldn't surprise me, and I don't really know if it would surprise that many other people if these two companies merged. And, I think that right now, Tesla, like, what have they done that's really lived up to the hype and sort of the brand that they built in the 2010s and early 2020s? Like, I think since he took over X and then has done the SpaceX thing, I just think that Tesla's been one of those ones where it's almost like the market's starting to forget about it. And, I say that now, and who knows what's going to happen 6 months from now with it. But I can't really think of anything Tesla's done at this point other than, okay, we're going to keep making the cars, the robo-taxi thing. I don't really know what's going on with that, and I think investors are maybe getting a little bit tired and seeking out other opportunities elsewhere with capital.
I mean, according to Bloomberg, and this was, let me see, the quarter ended, Q3 26. They must be on not a full, January through March. Yeah. So prior announcement was 722. They surprised to the downside, 34% adjusted EPS surprise. Revenue was a surprise to the upside, 7.29. And if you know nothing else, if revenue is growing, but your earnings are not growing as much, that's kind of a margin thing. I mean, it sounds like you're kind of like, really, they're just a car company. So you're kind of calling out Elon Musk here.
Okay, please, let's not.
I'm just saying.
It's not that I'm not a fan of Musk. It's that I'm ready to see like some follow through on this. Like, I want to see the robo-taxi take over. I want to see, what I imagine or envision, and I'm sure this is where he's thinking too, is a system and an infrastructure that's all interacting and communicating with itself. Imagine majority of the cars, if not all of them on the road, sort of being aware of one another autonomously. That's, who knows if that's in the near future or not, but yeah, at this point it's a car company.
Mike, I've been saying for a while, and he said it publicly that, not like I get inside info from Elon. I don't talk to Elon. It's the consumer cellular market. This is me. I'm guessing that they go into that and then they wind up dominating it. And one of the reasons why I think they need to go into it is he said during an interview that for self-driving cars, which would be the robo-taxis too, you need to have the right cellular. Like, you can't have dark spots where you're not getting cellular, because then the car can't operate. So, Mike, it looks like if I'm looking at the growth of earnings on Tesla, 24 was lower than 23, 25 was lower than 24. 26 is forecasted to be a little higher than 25, and then 27, 28 is expected to rebound. But I don't know. I mean, price to sales last 4 quarters trailing 9.7 times. Their price to trailing PE 179 times. I think Shane's point is, at some point you need to sort of justify those valuations.
Yeah, exactly. They can't just be a car company at this point. I mean, they had record amount of vehicle sales, but the margin on that business just isn't enough to justify the valuation, right? No one's ever really viewed Tesla as just a car company. They have to be a tech company in order to justify the valuation. That includes AI. That includes, the consumer cellular potentially. But
that's from Starlink, which is within SpaceX.
Right.
So it's not even Tesla, right?
Right. Yeah. If they were to merge the two companies.
Yeah.
But yeah, I mean, the market's pretty much saying we don't really care about the vehicle sales because we know the margins on that business. The margins, I believe, have actually gotten worse on that business. Tesla's, continually reduced the price on their cars over time. And that's helped sales, but it hasn't helped margins. And so, yeah, I mean, the technology side of this has to come along.
It's just one of those interesting things where it might make sense to merge the two companies. I mean, it seems like they share resources. So his vision, though, is like you could take your car. Like imagine you own a car, and the idea is most of the day your car is sitting there idle in your driveway. So what if your car can become, you put it on the network, and you're earning revenue on your car because it is a self-driving taxi. And there'd be so many cars out there that to take a self-driving taxi, it'd be really, really cheap. And I mean, that's sort of his vision, I think. And then you need the platform. So you need to subscribe to the platform. And now you're in the network. It's kind of this whole thing. Like that's the vision. I don't know. I mean, self-driving robotaxis, I think they're piloting it. I know in Arizona, Waymos are here. I don't think we have Teslas, but yeah, I don't know.
When I flew into Arizona to work on site, when we did our trip, Derek, I saw a Waymo almost hit a guy as my user-driven cab pulled up. A Waymo pulled up alongside it and almost swiped the car and then hit the guy next to it. And I've heard mixed things about him, but I don't know how I feel about getting into an unmanned vehicle just yet.
I haven't done it yet. I do want to. I don't know how I'd feel about it being on the freeway, though. I think they go on the freeway now. I could be wrong. So, all right. Next thing I want to talk about is just there's the rolling 3-month returns. This is from Fidelity. Data as of 7/19. So this is a little bit old. And what is this? Year over year return by asset class ranked best to worst on a rolling 3-month basis. Okay. So then what do you think is the best? Well, REITs. Imagine that. REITs did pretty well. Okay, so this is actually 3 months. This is quarterly. So you see how the chart works? How you have 25 and there's, So, REITs have been doing really well so far. S&P 500, not a surprise. Let's see. Gold is the worst performing on a 3-month rolling basis. Bitcoin, what is CN? CN is MSCI China. High yield's kind of in the middle, but at the top, it's what is JP? There's all these acronyms on this chart.
Japan. That's Japan.
Oh, Japan again. Okay. Yeah. ACWI.
Yeah, ACWI.
The dollar. Yep.
It's MSCI Japan is what that was. And then there's...
So international seems to be doing okay again, but real estate. Like who had real estate on their bingo card start of the year?
I will say one of my growth scanners has been pulling REIT names for the past 6 to 12 months. And I've just like laughed at it because I'm like, why is an aggressive growth scanner pulling REIT names? And now that I see this chart, I feel like I'm I'm the fool for not believing the scanner. But I mean, doesn't it make sense given the administration, given the climate we're in? Like, I'm not surprised real estate's doing well.
But
I
think about
this is
rates.
very pro. Yeah, that's true too. The rates thing. Yeah.
Like if you would have said rates would be higher, we go from almost assured we're going to have a cut this year to now we're pricing in hikes. Like, I don't think anybody had that coming into the year. No one was saying like, no, I think it's going to be a hike this year. I mean, Mike, we put, it's not all in, but we run some strategies where we have some real estate. We use some of the ETFs there. And so that's why you own a bunch of stuff. You own diversification, and sometimes the leaders come from unexpected places.
Yeah, it's a good diversifier. And if you look at this chart, I know the audience can't see it, but I think the main theme is that there's almost no pattern that you can follow, right? Other than Bitcoin either being the best performer or worst performer in any given year. I can't really pick out any other pattern. And so that's why, you include some REITs, even though you would expect them to perform better in a lower rate environment. They end up being one of the top performers the last 2 quarters.
The US dollar is the other thing. And if I'm making a bear case for the markets, I'm looking at the US dollar. And the dollar is very levered to interest rate expectations, of course. US dollar, at least the index, and it's very Eurocentric. So there's a trade-weighted US dollar basket in an index. There's also just the DXY, the US dollar index. It broke 100, and it looks to have broken out. I'll send this to you guys so you know what the heck I'm talking about. But it looks to have broken out above some of the resistance, near-term resistance. Like, this is something to watch because a higher dollar doesn't necessarily, it's a headwind for earnings because all the foreign sales, all the foreign earnings, things are reported in US dollars, US companies, and higher dollar reduces earnings from overseas. So you look at this and you say, okay, does it go to 105? It ended the day today at 101.46. Is it 105 or is it 110? Or is it higher? Like, the market doesn't like when the dollar, there's this zone of insignificance. I think we start getting a run here on the dollar. It kind of gets out of the zone of insignificance and becomes significant. And it's no surprise when you look at 2022, the dollar was on a steady march higher, hit a high in September, started to come back down. That was the bear market in 22. So I don't know. This is just something to watch. And we have the US 10-year was over, 4.7. I think the US 10-year hitting 5 would be problematic in the near term for the markets. In the long term, we seem to do just fine with over 5% 10-year in the 90s. So I have my eye on this. This is definitely levered to rates. Oil's going higher. The 10-year's going higher. The dollar's going higher. Interest rate expectations are higher. I don't think they're going to do anything next week. I mean, that's my prediction for next week because I think the Fed has done a really good job of telegraphing. But all of these things, like if you wanted to make an argument, Shane, that you were going to raise, I would make these arguments.
Yeah. Yeah, no, I think that's fair. I also think that, it's kind of worth noting here that, like Mike said, it's basically like Bitcoin and kind of commodities seem to be the extremes. Currency, commodities, and Bitcoins are sort of the top or the bottom performing, and they usually don't hang around in between. I also think it's worth kind of noting, or I guess I want to ask you, do you think that the dollar strengthening here has as much to do with what the U.S. is or isn't doing? Or is it more so the weakening of just other currencies elsewhere? Like, why do you think the U.S. dollar is holding up so strongly right now?
Well, I think it's interest rates.
Right.
I think it's interest rates. You could say there's a flight to quality sometimes. I mean, we still are the national, the world's currencies. Commodities are still, oil's still priced in US
Right.
dollars,
Oil's
things
still,
like that.
right.
And I think there's a demand for dollars too. And you can see that, and it's outside the scope. I didn't pull any of the charts, but certainly there's a lot of demand for US dollars. So yeah, I mean, and on a trade weighted basis too. So there's a trade weighted dollar index, and that is weighted against the currencies based upon the amount of trade with each country, where the US dollar index is really Eurocentric. I mean, you have Japanese yen, you have Canadian dollar in there, you have a Swedish krona, but then it's basically the euro. So no, I think that's part of it. But Mike, if I look at this, I'm just telling you. And do you have so Shane, I didn't get your prediction. Fed does nothing next week?
Yeah, Fed's going to do nothing and be even more ambiguous, and we're not going to be able to tell what
do nothing and say nothing. Mike,
exactly.
What do you think?
I think they're going to do nothing. I think we're going to get sort of a similar, somewhat hawkish outlook, and by hawkish, I think it's just not as dovish as people were hoping. Right? I think we entered this year thinking that there was going to be cuts, and so anything to the contrary, even if we're holding steady, seems hawkish at this point. But I sort of think that that's what it's going to be.
I mean, they're basically the Fed funds futures are basically pricing in a full 25-point cut at the September meeting, and on the borderline of a second cut by January. You know what's weird though? I was just thinking about this today. Like, Jerome Powell is still on the Federal Reserve, the FOMC. Isn't that wild?
When has that ever happened prior to now where someone stayed on after the fact?
I'm sure it has. I don't know. Not
in
my investing career.
She didn't do it, did she? I don't think.
No, she stepped down.
Yeah.
Yeah, she's not in my investment career. I mean, I think about going back to the 80s. No. Well, here I'll ask Google Gemini. How's that? Last time a Fed chair stepped down but remained on FOMC. Let's see what Gemini tells us. Oh, thanks, Gemini. Jerome Powell is the last time. No. Eccles, 1948, before Powell. That's the last time.
That was before all of us.
Yeah. So he chose to stay on the Board of Governors, serving till 1951 to defend his monetary policies and central bank independence. That was 1948. So he stayed on another 3 years.
So it'll be another 80 years. It'll be like 2100 the next time someone does that again after Powell.
Normally, they want to get off the Fed because that means they can go on the highly paid speaking circuit. I guess they could take money for speeches too. Wasn't that guy writing papers for Iceland on how there was no problem in Iceland? That guy was on the Fed, and then it was right before 2008. Maybe they've changed that. I feel like he was getting paid money to consult Iceland. I could be wrong on that. I don't want to get sued, so I'll Google that. I'll retract that. I never said it. No, like if I'm Powell, I want to ride into the sunset. The only reason why he's doing this is because he wants to make sure there's no sort of legal stuff against him. And this is the only leverage that he has. But you notice, though, he's doing no speeches. He's doing no TV. He's doing nothing. Like, this guy is probably listening to his favorite albums and swimming during the day. And that's it. That's my guess. All right. Do I dare go into, I have a brief MicroStrategies thing. Strategy, whatever we call it, right? So do you remember I was saying, if you go to the strategy.com site, and I just sent that to you, not like you can't type that in yourselves, and you go to the stretch, the STRC, that's their preferred. Do you remember I was saying the way they were doing the Sharp was, in my opinion, not correct? They updated it. I'm going to take credit for this because I had a problem with the way they were doing Sharp. Hover over the Sharp now, and it is now doing it the correct way, it looks like. And you have a negative 1.02 Sharp. So Sharp is the return minus the risk-free rate divided by the standard deviation. And they're doing it on 30 days. Can I take credit for this?
Can you remind us do you remember how they were calculating it before?
Oh, yeah. It was like the effective yield instead of the return.
Yeah, that's right.
Yeah. It's the effective yield. They're also using a risk-free rate of 4%. And they say the current 3-month yield on U.S. Treasuries updated every day. I do not believe the 3-month Treasury is 4%. Am I wrong? Did I miss something? Did we go to 4% on the 3-month? Because the way I see it, well, actually, all right, 3.91. So they're rounding. They're rounding. All right, I'll leave them alone for that. But good job, strategy. Looks like you have the correct Sharp on here. Nobody else cares about this but me. It's okay.
Someone cared. They changed it.
They did. I don't know. I mean, I'm not looking at this all the time. I feel like, well, they've updated some other stuff. So click on MSTR. They've added new thing because it's new. And I think they've updated how they calculate some of the, like MNAV is calculated differently now. So now it's like some Bitcoin per. It doesn't matter. I've spent enough time in this, but you remember that, right? I was like, they have a negative Sharp, and they had like a super positive Sharp, or at least positive. I don't remember what it was. So is MicroStrategies? See, this is what happens. You guys get me talking about this.
Derek, if I don't count any of my losing trades, I'm 100% on all my winning trades. That's right. It's so funny because I saw him post him being a sailor recently that they sold Bitcoin to increase their USD reserve, and it just people were commenting some very sharp observations about how he's been very critical of, I would never sell Bitcoin. I would never do this. And now he's talking about increasing strategic US dollar reserves for strategy, which we all know it was to pay this. But I mean, at some point, stock closed at 91.67 today. The recent 52-week low was 81.81. And the 52-week high was 419.95. I mean, at what point, like if Bitcoin even rallies here, do people go back into this, or do they just say, you know what, if Bitcoin's going to rally, I might as well just put my money in a Bitcoin ETF and not even expose myself to this? Like, is the jig up?
I don't know. Look, I know what people think this does. If you cover up the name of the company and you just go back to Finance 101, you say, what is the equity in this company? So you say, what's on their balance sheet? What is their debt, including preferreds and bonds? And if I was going to acquire this company, like, what am I getting? And you kind of go back to, I don't know if you call it first principles or whatever, but that's what I look at. And so they have a new lineup here. It says Ledger and the list. So it looks like July 6th, they sold 2,225 Bitcoin. And then on June 30th, they sold 1,363. And they had some buys in between the June 1st sell, but June 1st was they sold 32 Bitcoin. So, it looks like they sold some Bitcoin, which I don't think, at least some interviews I've seen with him. And again, I'm not watching this like a lot of people. He kind of said, you never have to sell. So look, I don't know. I'll just kind of do my normal public service. And when you look at Stretch, STRC, which is a perpetual preferred, I believe, the effective yield is 13.81%. The dividend is 12%. The price is 86.89. It's below 100, which they consider, their offering price or par. If the risk-free rate is 3.9 and your effective yield on this is 13.81, just think about how far above this is to the risk-free rate, and you are taking multiples of risk above the risk-free rate. In other words, you don't have a yield like that without risk. And that goes for high yield, it goes for corporate bonds, it goes for any asset. You know what you can get risk-free on an annualized basis right now? You can buy a treasury, hold it for the next 3 months, and you'll get on an annualized basis 3.9%. Not 3.9% over 3 months, but annualized, like you're going to do it again and again. So that's my my public service announcement. Can we be done talking about MicroStrategies? Are we done? Strategy, whatever it is? Okay. I want to talk a little bit about what's coming up in earnings. And like, I feel like last earnings, we didn't get as much of a dramatic move on some of these companies. Like the move on Tesla is pretty significant. I think the move on Google was definitely significant. So what's up next then? So next week, if I pull up our earnings thing here, I put it into our packet this week. Let's see. Yeah, kind of a big deal. Microsoft and Meta, Wednesday after the close. Get your popcorn for that. Apple after the close on Thursday. Keep, have 2 servings of popcorn there. There's a lot of stuff packed in here. Exxon, Chevron, Friday the 31st. If you eat at Chipotle or Starbucks or drink coffee at Starbucks, they're there. Like the volume is really high next week. But look, I mean, it's Microsoft, Meta, and then Apple. And Amazon. Like that's 4 of the 7 Mag 7 are next week. So if I look, so Mike, I'll ask you, let me start with you. Which of these are you most excited about seeing and why?
Apple. I'm interested to see in how the market reacts to the conference after the earnings number. I'm sure the earnings number, well, I'm not sure, but usually Apple reports earnings that aren't too far off of what they estimate. But I'm interested to hear what they have to say, see if there is any update on their AI plan and how the market reacts to that, whether the market reacts positively because there is no update. And Apple's been trading different than the rest of big tech recently. It seems to be on big down days, Apple's stable, sometimes up. And when the market recovers, Apple sort of sells off a little bit. So Apple's the one I got my eye on. I
mean, the implied volatility, Mike, is only, I think, upper 30s. Pre-earnings, we're still a week out. Like, that's not very high. They're not expecting that big of a move post-earnings.
No, if you were to buy the at the money, so if we want to take a look at the options, we can look at the July 31st expiration, the 332.5 strike. If you were to buy that put and call, which basically means you're betting on the stock moving a certain amount up or down, and you profit if it moves that amount or more. It is pricing in like a 4.5% move.
Yeah. Not much.
Not much.
Yeah. Like Shane, you look at Microsoft earnings the day before, of course, Wednesday after the close, 64 IV, 65 IV. So implied volatility, you take that divided by 15.857 or 875. Anyway, or you do the rule of 16 divided by 16, and that tells you about the expected one-day move. So, yeah, like Shane, you think about Microsoft and Apple. The option market is telling you, Shane, that it thinks that Microsoft is going to move more post earnings than Apple.
Yeah, no, I could see that too, given the fact that Apple is at the highs. Typically, when a stock is trading at a higher value, volatility in that name is typically lower, I think. And I think that just given Microsoft's range over the past 52 weeks. And I mean, even if you want to, get into it, it's June 1st. June 1st, a stock had a high of 466.32. And a couple weeks later, 349.20 on the low on June 25th. So, this stock's been trading in 100+ point range for the past month or two now, 2 months. I mean, that's that's like a 25% range, 25% range on the stock. So I think that the market going into Microsoft is, just going to be ready to either punish it the same way kind of Google saw, or, maybe it finally gets some news that it likes to hear and they're positive about this AI and this CapEx stuff, and they can finally catch a bid. But this is the one that's been really, I never thought I would see Microsoft trading. What was the list here that we said it's below its 50?
Oh, it's down, 31, 35%? Yeah.
Like I never thought I would see 31% down in Microsoft and the S&P off its all-time high by 3%. I would have never believed you if you had told me that was going to happen this year.
There's some nuances in the earnings too. And what's interesting with Microsoft as well is they have this investment in OpenAI. Alphabet, this was from Fortune, and the title of it was, I don't know if you guys knew this or read this already, Anthropic and SpaceX just handed Google the biggest profit in company history on paper. And there was a dash on paper, so they wanted to emphasize it. It said Alphabet made history Wednesday with a quarterly profit that stretched into 12 figures for the first time in the search giant's history. Alphabet, and I'm skipping around here, grew its bottom line by 298% year over year in the second quarter, totaling an astounding $112 billion. And that's more profit in 3 months than 459 of the Fortune 500 companies generate in top line revenue in a full year. Profit compared to full revenue. Okay, so what gives? I'm reading from the article. Alphabet's Q2 revenues increased by an impressive 24%, with Google Cloud business reaching an 82% growth clip. Results the CEO, Sundar Pichai, called proof that the company's full stack approach to AI is delivering real, measurable value. Well, that's just $99 billion in additional or other income that's not directly produced by Alphabet's day-to-day operations. They go on to say, a footnote in Alphabet's Q2 earnings release provides a bit more insight about where these record-shattering profits came from. Alphabet booked $99 billion in unrealized and realized gains on the equity securities in its investment portfolio during the quarter, adding $77.1 billion to Alphabet's overall net income after taxes. The windfall accounts for $6.26 of Alphabet's $9.11 in earnings. Most of the $99 billion in other income is from Alphabet's AI investments, primarily Anthropic and SpaceX. So I thought that was really interesting. And, this is what a full analyst is doing. They're looking at the footnotes. They're looking at all this stuff. And like Mike, when I read that, the move post earnings maybe isn't that surprising. I mean, they're basically saying, well, sure, you had this revenue, but that's not going to happen every quarter.
Yeah, I mean, the estimate was like $2.80 something cents a share, and it ended up being over $9. And I saw the headline, and I was like, what is going on with this? And the article that I was reading said, we're monitoring the situation, and we'll report something back about this big earnings beat. And then sure enough, that's the reason why. So you got to focus on the core business and what's repeatable and what can continue to grow to really determine what the future prospects are. Because like you said, that's not going to happen every quarter.
Yeah,
or maybe ever again.
It was just interesting from a footnote standpoint. So I don't really have too much to say, beyond that. But this, I think, is the market we're in right now is starting to really dive into the sources of revenue, where it's coming from, where it's going, and I guess in theory, the market discounts all. So like the market knows this, but yeah, it's kind of interesting. And I guess if Anthropic comes out, I don't know what their valuation is right now. Would Google put it down? I guess I could look in their footnotes. But anyway, all right, guys, let's go to recommendations this week. Shane, I'm going to start with you.
All right, so I'm going to give two. I'm going to give a hold on Project Hail Mary. So unfortunately, we are now split across the three of us on that one. And then I'm giving a preemptive buy on the new Spielberg movie.
Okay.
It's called Disclosure Day, and apparently it's one of the greatest movies on extraterrestrials that have come out. I don't know. I might like it. I might not. I'm really picky with these kinds of movies. Like you had said, like The Martian, you love The Martian, I think, but then Hail Mary wasn't as great for you. I'm kind of the same way with space movies and this stuff, so we'll see. But it's gotten great reviews. So.
Yeah, Project Hail Mary. So Mike gave us a little context last week about the book, and apparently the book, the book explained a lot more, is what you're saying, Mike.
Yeah, when he wakes up from his coma, he doesn't remember exactly how he got there. And so the reason that throughout the movie he's having these flashbacks is because it's actually coming back to him in real time. Okay.
All right. Mike, what do you got?
I don't have a recommendation, but I do have, this isn't a recommendation, but Patrick Kane is back on the Blackhawks. Couldn't be more excited about that. 2-year deal. Watching him and Bedard play together is going to be a treat. I don't know, he's in the later half of his career, obviously, but still a good player and happy to have him back.
Yeah, I mean, that seems like a good fit. He still is effective on the power play. It's like we're doing an NHL podcast at this point, but good for the Blackhawks. Because you have Bedard, you don't want to waste all these years of his talent. So, and look, I went to a game I saw the Blackhawks play, in Chicago. It's a great atmosphere. So, yeah, it's not really are you recommending people should watch the Chicago Blackhawks hockey team this year? Maybe
Go to a game if you can. If not, check out a game on TV. They're going to be fun to watch. A lot of good young players. And then now they brought in Patrick Kane.
Okay. This was a little bit better than the time someone recommended their local air conditioning company. So, but not.
I've recommended a grill before.
Oh, that's right. You have.
Yeah.
That's right. The grill. So I actually did see Odyssey, and I saw it with my son, 70 millimeter IMAX. I'm going to give it a very strong buy. It's on my conviction list. And I thought it was great. I thought Christopher Nolan delivered. If you like Christopher Nolan movies like Dunkirk and Oppenheimer, and he did the Batman. What else did he do? Interstellar. It was great. I can't tell you, I've only seen it in the 70 millimeter IMAX, and people were shocked we got tickets. But I think my son told me to buy them a month and a half in advance. So I was like, yeah, sure, I'll buy them. And we went the opening weekend. I looked again because my son wants to go see it again. The latest you can buy a ticket, I think, is sometime late August, and it's sold out in the IMAX, completely sold out from now until then. So strong buy though, and I think it wins the Oscar. It's got to get nominated. I think Matt Damon wins an Oscar, and other people like John Leguizamo should win an Oscar, and maybe Anne Hathaway. I'm just saying. So I know you guys will get to it at some point, but I'm a strong buy on it. So there you go. I'm a strong buy in buying tickets early, by the way, now too.
Just in general, or for?
I had no idea it was going to be this popular. People were like, "Oh, we went to go buy tickets. You can't get tickets for a month." Yeah. It must be the IMAX.
It's got to be. It's very selective, I'm sure. But still, isn't that good for people who like movies? I think we've all been hoping for a revival, comeback for going to see movies in theater, and this is the kind of stuff that needs to be coming out. We're gonna see that.
It was so good. We made fun of AMC too. We were like, "Who's even looking at that stock?" Look, it was $1.50. It closed today at $2.27. So on a percentage basis, that thing is running. I don't know if it's going to help them get a profit, but yeah, I think it was $1.72. It's $2.27 right now. So what's the percentage change there? It's pretty good on a percentage basis. I'm not recommending AMC. I'm just telling you, Yeah, it's up 32% from that show we did. So there you go. I guess, so I was talking to my son and I was like, why don't they just open up more IMAX theaters? Apparently the projectors, nobody makes them anymore, and they'd be really expensive to build now. So I don't think anybody's doing that. Like, I don't know what's going to happen to that format. Maybe it just all becomes digitized and they don't do a projector. But the theater we had actually had a projector, which was cool. So, all right. You guys aren't excited about Odyssey. You'll get there.
I'm jealous that I haven't seen it.
Yeah, you got to do it. You got to go. What's the theater in Illinois? There's the one, the 70 millimeter IMAX. Is it Woodridge? Is that?
It's far. That's all you need to know. It's far.
People are traveling to other countries to go see it. Yeah. I think the biggest IMAX screen is either in Melbourne, Australia, or there's one in Germany. Someplace in Germany. It's like, I don't know how many stories high. It's like humongous.
38.8 meters wide and 21 meters tall. Jeez.
Yeah.
Yep. Leonberg, Germany.
I'm sure it's fine in like a normal, like, you know, whatever your biggest normal local theater is, I'm sure it's fine. I've only seen it in IMAX. And he shot the whole thing in IMAX. So, all right, we're done. We'll come back next week and see everything we got right, everything we got wrong. I'm sure we'll get a lot of things wrong. And lots of earnings next week to parse through as well. So it should be a good week. We'll see everyone. Take care.